Something fundamental inside the global economic system has already changed. Most people believe the next resource conflict will center on oil, rare earths, or semiconductors. But the structural shift already underway points somewhere quieter, less visible, and far more consequential. The next strategic bottleneck is silver. Not as a speculative asset, not as a collector's metal, but as a critical industrial input sitting at the center of electrification, defense systems, artificial intelligence hardware, and energy transition infrastructure. What's actually happening beneath the headlines is not a price story. It's a control story. Governments, industrial blocs, and supply chain architects are repositioning around one simple reality. Modern economic power now depends on access to a narrow set of physical inputs that cannot be scaled infinitely. Silver sits at the core of that list. The public narrative still frames metals in terms of markets and commodities. The structural reality is about industrial sovereignty. Demand for silver is accelerating across multiple sectors simultaneously. Solar panels, military electronics, high-performance computing, semiconductors, medical systems, and advanced manufacturing. At the same time, global supply is constrained by geology, extraction costs, and the fact that most silver production is a byproduct of other mining operations. This creates a structural imbalance, not a temporary shortage, a systemic pressure point. The global system is quietly reorganizing around that pressure. Institutions are not publicly declaring a silver race. They don't need to. Their behavior already reveals it. And once industrial systems begin repositioning around a critical material, reversal becomes extremely difficult. This is not a speculative future scenario. This is a structural transition already in motion. Mainstream coverage struggles to frame resource transitions unless they are already in crisis. Media narratives prioritize price movements, market volatility, or geopolitical flashpoints. But structural resource positioning happens slowly, quietly, and across multiple institutions at once. That complexity doesn't translate well into headlines. The financial media treats silver primarily as a trading instrument. Political media treats it as a secondary commodity. Technology media treats it as a component, not a constraint. Each sector sees only a fragment. This creates structural blindness, not conspiracy. Incentive alignment. Corporate media depends heavily on financial institutions, advertising from large corporations, and access to policymakers. These actors have little incentive to frame resource competition in systemic terms until constraints become unavoidable. Complexity is avoided because complexity reduces engagement. But more importantly, complexity exposes structural vulnerabilities. If the public understood that industrial capacity depends on materials with tightening supply curves, it would change how people interpret economic stability. So, coverage remains fragmented. Silver is discussed as an investment, a commodity, a niche industrial input, rarely as a strategic choke point. This is where the public explanation collapses. Institutions don't react emotionally, they react structurally, and when multiple governments begin securing long-term mining contracts, subsidizing domestic extraction, building strategic reserves, or reshaping trade agreements around specific materials, it signals something deeper than market interest. It signals system-level positioning. Every major economic era has been defined by control over foundational resources. In the early industrial age, coal determined industrial capacity. In the 20th century, oil defined geopolitical power. After World War II, access to energy and manufacturing inputs shaped global alliances and financial systems. But over time, the structure changed. The post-1970s economic model prioritized financialization and global supply chains over domestic resource security. Production dispersed, extraction concentrated, costs optimized. This worked as long as supply chains remained stable and material inputs were abundant. After 2008, a new pattern began to emerge. Governments realized that dependence on complex global supply chains created systemic vulnerability. This became more visible during the financial crises, trade conflicts, and pandemic disruptions. The lesson was clear. Efficiency without redundancy creates fragility. Since then, major economies have gradually shifted toward reshoring critical industries, securing strategic materials, and reducing reliance on adversarial supply chains. Rare earths drew attention first. Semiconductors followed. Battery minerals entered the conversation. Silver remained largely outside public debate, but structurally it occupies a similar role. It is not easily substituted. It is not easily scaled, and it is essential to multiple high-priority industries simultaneously. Historically, when a resource meets those criteria, governments eventually treat it as strategic. That transition is now underway. The modern trigger isn't a single announcement, it's a convergence. Global electrification initiatives have accelerated demand for solar infrastructure. Silver is a critical conductor in photovoltaic cells. Defense systems increasingly rely on advanced electronics and high-performance circuitry. The silver's conductivity and reliability make it essential. AI infrastructure and data center expansion require complex hardware manufacturing. Again, silver plays a role in components and connections. At the same time, mining output has struggled to keep pace with industrial demand. Most silver is produced as a byproduct of mining for other metals such as copper, lead, and zinc. This limits how quickly supply can scale in response to demand. Even when prices rise, production doesn't increase proportionally. That's a structural constraint. Governments and corporations are responding. We're seeing long-term procurement agreements, strategic partnerships with mining regions, increased investment in domestic extraction, and quiet stockpiling behavior. None of this is framed as a global race, but the pattern is unmistakable. This moment differs from previous commodity cycles because demand is not driven by one sector. It's driven by multiple structural transitions at once. Energy technology, defense and infrastructure. When multiple strategic sectors depend on the same material simultaneously, competition intensifies, not publicly, structurally. And once industrial systems reconfigure around securing that material, reversal becomes unlikely. Financial markets have begun adjusting, but cautiously. Silver prices move in cycles influenced by speculation and macroeconomic conditions. But institutional positioning is less visible. Mining investments are rising. Governments are offering incentives for domestic production. Trade agreements increasingly include provisions related to critical minerals. Central banks are not stockpiling silver at the scale of gold, but state-aligned industrial policy is clearly shifting toward resource security. Corporate behavior provides additional clues. Large technology firms are securing long-term supply contracts. Energy companies are integrating material sourcing into strategic planning. Defense contractors are prioritizing reliable access to key inputs. When multiple sectors begin locking in supply simultaneously, it signals anticipation of constraint. International forums and economic alliances have also begun emphasizing critical materials security. Silver is often included in broader lists of strategic inputs. This language matters. When policymakers start using terms like resilience, security, and strategic autonomy, it indicates a shift from market logic to state-level planning. Markets optimize for cost, states optimize for stability. Those priorities diverge when resources become constrained. Resource transitions always redistribute power. Countries with significant silver reserves or refining capacity gain leverage. Countries dependent on imports face increased vulnerability. Industrial sectors that secure early access to supply strengthen their position. Those that rely on spot markets face rising costs and uncertainty. Financial capital benefits from volatility and speculation. Industrial capital benefits from stable access and long-term contracts. This creates tension between financial markets and manufacturing systems, Main Street versus financial capital. When critical materials become constrained, governments often intervene to protect domestic industry. This can mean subsidies, export controls, strategic reserves, or trade restrictions. Such measures shift power toward industrial planning and away from purely financial logic. Workers in manufacturing and infrastructure sectors may benefit from reshoring and investment, but consumers may face higher costs. Extraction regions gain importance, but environmental and regulatory pressures complicate expansion. There are no simple winners, only shifting balances. What's clear is that control over critical materials increasingly determines economic leverage, not just financial capital, physical inputs. For the United States, the implications are structural. The U.S. retains significant industrial and technological capacity, but it relies heavily on global supply chains for many raw materials. If silver and other critical inputs become constrained, policymakers face difficult choices: reshore extraction and refining, secure supply through alliances, or accept strategic dependence. Each path carries costs. Domestically, resource security efforts could drive industrial investment, infrastructure expansion, and job creation in certain sectors. Globally, competition for materials could intensify geopolitical alignment. Economic confidence depends not only on financial markets, but on the reliability of physical supply chains. If resource constraints begin affecting production timelines or costs, it reshapes expectations across industries. Institutional legitimacy also comes into play. If governments appear unprepared for material bottlenecks, public trust erodes. If they respond with heavy intervention, markets react. Balancing those pressures becomes increasingly difficult. This is not a short-term cycle. It's a long-term trajectory. This is not a story about silver prices. It's a story about structural positioning. The global system is entering a phase where access to critical materials determines industrial capacity, technological leadership, and strategic autonomy. Silver sits at the intersection of multiple transitions: energy technology, defense, and infrastructure. When one material connects that many sectors, control over its supply becomes a strategic priority. What you're seeing is not market noise. It's systemic adjustment. Institutions don't announce these transitions publicly. They move quietly, incrementally, structurally. The resistance you're seeing to resource nationalism, industrial policy, and supply chain restructuring is not ideological. It's systemic. Systems fight change before adapting. The question isn't whether this shift is happening. It already is. The question is how governments, industries, and financial systems respond as constraints become more visible. Who secures access? Who faces shortages? And how does that reshape global power? Because once resource competition becomes structural, it rarely reverses without a broader economic realignment. If you're trying to understand where global industry and geopolitical leverage are heading next, watch the materials that make modern systems possible, not the headlines. Not the markets, the inputs. This is Josh. You're watching U.S. Power Report. If this analysis helped you see the structural forces beneath the headlines, subscribe for long-form breakdowns on power, policy, and economic systems. And consider this: if the competition for critical materials is already reshaping global strategy, what happens when multiple bottlenecks emerge at once? We'll be examining another institutional shift already forming inside the U.S. system in the next report.